Well, hello everyone. Welcome to Friday. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach with Schwab and delighted that you guys are all joining me live. Now, if you're watching in the archives, kudos to you, because you know what happens when the market starts going down? People stop watching and they stop looking at their accounts, and many people go with that head in the sand approach. And it's really interesting because when the markets are really bullish, everybody wants to participate and kind of outdo their neighbor and their friends and all of that great stuff. But when we're in times like this, a lot of people kind of shut down and they stop watching and they stop participating, and they think, oh, I'll come back when, the bloodbath is over. So I want to commend each and every one of you that is watching this for being here and for not letting the tide take you where you may not want to go, or the river, which tends to be flowing in a downward direction right now. So our topic for today is going to be bearish strategies, and it is going to be bearish conditional entries, because today the market's getting a little bit of a lift, a little bit of a break, and it could be setting up some what we call bear flags. So we are going to hug a bear today and set up some conditional entries so that if an entry appears that might meet our example trading plan, that we get in right at the front end of it and don't miss it. So if you are not following me on X, I invite you to do so. I'm posting content there on a daily basis that I think you will find helpful. It's a way for me to communicate with you and you with me outside of webcasts like this. We have the privilege of having Connie Hill with us in the chat today. She's a friend and a fellow coach, and she understands these long put strategies that we're going to be talking about today inside and out. So if you have any questions, please don't hesitate to ask. And between Connie and I, hopefully we have answers for you. I have my chat sitting right here. So I will, I will be looking at that occasionally, to just see what questions you may have. Okay, so keep in mind, this is Trading a Smaller Account. It is an intermediate to advanced level class. So if you're a dead nuts beginner, know that this may feel a bit like drinking out of a fire hose. And that isn't to say that there might not be a lot of valuable content. But again, your ears may be bleeding kind of by the end of it, and that's okay. Know that options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to learn and become familiar with the platform and make sure you understand your strategies, your plans, and then how to execute them on the platform before you consider trading in your live account. One of the nuances or differences is that short positions will never be assigned early in Paper Money. That can happen in a live account. Okay, so next Thursday, I'm heading for Chicago. We have an advanced option 2-day class. If you haven't registered, registration is now closed. If you live in the Chicago area, would like to attend, I'm sure we will not turn you away at the door. You can register on site. But the reason I tell you this is that these are very popular events. They are held, free of charge. We'll even pay for your parking. We'll provide you breakfast. We'll provide you lunch. So they're really incredible events, and not to manage that we're feeding your learning in addition to feeding your belly. So, but they fill up fast. So if you want to go, please register sooner rather than later. We've got the Triple Ds coming up, Detroit in April, and Dallas, followed by Denver at the beginning of May. And, I will be at the Chicago event. If you're there, please don't hesitate to come up and introduce yourself. So I've decided that this year I'm going to spend less time doing kind of a market overview, because Kevin Horner and guests, so his guest this morning was Mr. James Boyd. They go over the markets in that Trader Talks, the first webcast of the day, and they do an exemplary job of it. But if you missed it, the S&P 500, and I just posted something on this, it is down over 6% year to date. It is down, we've got a big rally happening today. And some might say, I'm doing this little series on candlestick patterns. Some might think this looks a bit perhaps like a morning star pattern where, we had a down day and then, today it's rallying. But, we are down from this high, still 8.5%. Yesterday, we were down over 10%, which officially puts us in correction territory. So, Chicken Little has been out running around the yard and losing her mind, and people are paying attention. Or they're shutting down and doing nothing, like as I said earlier. So, please pat yourself on the back for being here. And the NASDAQ, kind of a similar pattern today. This a morning star pattern, which might be considered bullish. Now, others might say, hey, this could just be a bear flag setting up, and it could be. But, from our highs here, even with today's bump down almost 12%. So this is not for the, this is enough that this type of action will drive some people to the sidelines. And volatility coming down a lot from the 30 that it hit, well, 29.57, so I'm rounding, that it hit earlier this week. But I mean, at 22.42, if we look at the last year, excuse me, I've been off the last couple of days, not feeling my best, shall we say. It's still at the very high end of where this fear index has been over the last year. And as I said in a webcast earlier this week, the market likes stability and consistency and predictability, and it's not feeling a lot of those vibes lately with what's going on, within our country with respect to tariffs and trade and all these other types of things. And that has had global repercussions. And so, that's created a lot of angst and uncertainty. And the market doesn't tend to like that. And that is certainly reflected here in the VIX. Okay, so just let me have a quick look at the chat. Yeah, somebody saying, I'm eager to see what trade strategies Barb's going to be trading. And you know what? I looked at a whole bunch of different strategies, so yeah, just one sec. Okay. So, what bullish strategies or bearish strategies might we consider? Well, we could consider, and let me just look. Let's start with Delta Airlines. So the airlines have really taken it on the nose in the last couple of weeks, right? Year to date, and we're just March 14th. This stock is down 24%. From this high here on January 22nd, it's down 35%. Like, holy smokes, Batman. That is a whole lot of ugly, right? Right. I don't think anybody would argue that if you were an employee of this company and held a lot of shares, or if you're just a shareholder, that's a lot of pain. And so what we have seen, and if you're newer to looking at charts, I do teach a Getting Started with Technical Analysis on Tuesdays, and you may want to check that out. But we're seeing this kind of steady stream. It goes down, rallies for how long? Typically a day. Rallies one day, whoo, biggest one of all. And today it's rallying. So could this just be another bear flag? And you might say, I think so. Well, do we trade what we think? We trade what we see. And so do we see an entry today? We do not. But if we think that this might, in fact, be another bear flag setting up, how can we prepare ourselves? Well, we could do a conditional order. here. And we've got earnings coming up, not, I think, until April. So if you hover over this candle, April 9th. So could we say, hey, this low of this candle today, even though it's an up day, the low is 44.18. So we are going to make a note of that. So we're going to come here and switch this to our scratch pad. And so these are bearish. And we are going to be, for most of these examples, long puts or buying puts with 1 ATR targets and conditional entries. And so our today's low, so here's our example one. And so our entry would be today's low, which is that 44.18 minus 20 cents. So we say, okay, if it goes to 43.98, we want to enter this trade. And then what would our target be? So our target might be this 1 ATR. And what does ATR even mean if you're newer to this class? Now, it's 287. So this is the amount over the last 14 days that this stock has moved from top to bottom, from the high of the day to the low of the day. And if you want a more complex definition, if you come to studies and edit studies, one, you can add this to your chart very simply. You type in ATR and click on it, add selected, apply, and okay. I already have it, so I'm not adding it again. But if you click on this little question mark, it will give you a very thorough definition of what this ATR is. And so what we're doing, and you know, I think it was 3 years ago when the S&P 500 was down 18% by the end of the year. The NASDAQ was down almost 30. And I've been teaching this class now for several years. It was our most profitable year in this class. And most of, you know, and these are example trades and not recommendations, but we tracked our results and it turned out to be our most profitable year until last year. And you know, last year was a little bit of an anomaly because we actually went 14 months, not just 12, because we started that account over in November. But so just because the market is bearish doesn't mean we need to pack up our things and go away. If we know how to trade options, we can start dusting off some of those bearish trading strategies, and a long put is one of them. And so here our target that would then be 43.98 minus 287. And with these, we are not going to put in the exit. We'll put the exit in when the trade fills. And the exit would be 1 ATR above the high of the day we entered. So this is 43.98. Feel free to double check my math. Minus 287, 41.11. Okay, so somebody's asking me to explain why I subtracted 20 cents from today's low. Because if you look at and you know what, I haven't put it in the playlist yet, but what some will have as part of a bull flag pattern, their rule will say, when I see a bull flag, I am going to enter that trade when I have, and I'm just going to write this out here, a close below the low of the high day. And so we're willing to kind of modify that a little bit and say, hey, if it trades below the low of the high day, so this is what we believe will be the high day, because the last one, two times, and here it came up a smidge. So like we've only had like one day, most of these have been one day it's gone up and then it's continued to go down. And so the assumption is if it goes 20 cents below today's low, then we'll have our entry. And then we're going to put our target in at 41.11. Does that make sense? Okay. I hope so. If not, put in another question and I'll come back at it another way. But that's why I did it that way. Okay. So to put this trade in, we're going to come to the trade tab and we are going to come over to April because we want, even though we think that given we get into the trade, we're likely to only have, be in the trade for a few days. We want to have at least 20 days plus the number of days we're planning to be in the trade. So we're going to come out to April, which means we're going to pay a little more. So if we look at, and we want to be on the put side, so we've got lots of volume here. We have lots of volume. And when you look at the example trading plan, and I have one for a long call with a 1 ATR target. So on Monday or Tuesday, I'll do the long put version and you'll see it in the trade management mini session series. I'll show you where that is in a minute. But do we trade more than 1 million shares a day on this stock? Yes. Is there a lot of volume, at least 20 times the number of contracts we're thinking of trading? Yes. Do we have a tight bid-ask spread? 7 cents. We want it to be under 10. Here, this is 5 cents. And again, we want it to be under 10%. So yes. So when we look at this, in fact, this one's only 5 cents. That's a tighter bid-ask spread. And, we've got lots of volume on both of these. So if we look at this and we say, okay, we're going to do one contract because we don't want to risk more than $500. If we came down here, we could do more contracts. We could do 4 or 5, but the bid-ask spread is significantly more, which I find interesting. Well, now it's 6 cents. And this is 6 cents. So I guess it's close to the same. So if we did this, we could do 4, this 40. So we are going to buy, and we are going to, actually, we'll just do a buy. And we're going to do 4 of these. And then we're going to come to single order, make it a first trigger sequence, right click, create an opposite order. And then we're going to make this a market order that's good till canceled. And we are going to come and click our sprocket, which brings up a conditional window, and say, if and or when this gets to 41.11, we would like to exit the position. And then our condition for entering, so we're also going to make this a market order that's good till canceled, and hit our sprocket and say, we only want to enter this trade if Delta goes at or below 43.98. Now, can we just set this and forget it? Yeah, no. Absolutely not. So when we look at this, and we're going to bring our window over here and say, okay, our entry is if Delta goes at or below 43.98. It's currently trading at 45.48. Does that make sense? Yes. And then we want to exit when it gets to 41.11. Yes. How much could we lose? $426. All of what we're paying to get in. So we're putting this in our long put group, and this is a conditional order with a 1 ATR target. Okay. So we're we're looking to buy the 40 put and then sell it when it gets, close to when it goes at or below this 41.11. So what we're going to do on Monday, because we will get to meet Monday and Wednesday of next week. And, Monday and Friday, it's trading a smaller account. Wednesdays, it's trading price patterns. But if we don't get into this trade on Monday, so what we'll do is at the end of the day, Monday, if we haven't entered this position, then we'll look at where that candle is, and we might move our entry up. Or, we'll look at what that candle does on Monday. And so we'll look at this again on Monday and Wednesday. But this is something that you're going to look at daily until you're in. Okay. Do you worry that if it gaps down, that is a possibility? So Kevin is saying, do you worry that if it gaps down tomorrow at the open by more than one ATR, you could get in and immediately get out? That's possible. I'm not saying that can't happen. It can. But, the way this has moved thus far, we haven't seen, on the entry a big gap down, but here it gapped down. So that is a possibility. And so, some might say, well, I'm going to have my entry in here, and I'll wait to add my target until I get in. And so we could do that as well. And so, why don't we try that on our second one? So the one thing though is, like, on a day like here, where let's say you got in on this day, you got in and it really sold off. So you may have gotten in, it might have hit your target and you could have been back out. Do you see what I mean? Like here, you could have gotten in and then it might have come down and hit your target and you would have been back out. But if you didn't look at it during the day, then it rallied and you stayed in. Now, mind you, that wouldn't have been too big a hardship because it moved down the next 4 days in a row. So one of the easiest ways, so DP is saying, to build off Kevin's question, can you set a double condition on your order? And, that makes my head hurt. Thinking about, I'm trying to keep this simple because the confused mind does nothing. And so what you could do if that's a concern, how about we look at United Airlines? So here we are again, and very similar type of pattern, right? Like 1 day up, 2 days down, up, down, up, down, up, down, down, up, and then 5 days down and an up. And so could we put in a similar thing here and say, hey, today's low is 69.86. So UAL, our entry would be 69.86 minus 20. So 69.66. A lot of sixes going on there. And then we might say our target, given the 1 ATR, to keep the same formatting, is 554. So our target on this would be 69.66 minus 554. Okay, mathematicians unite. 69.66 minus 554, 64.12. Okay, so that's our target. And so what we might do is just say, hey, if we come out to April, and somebody had a question about Delta. Now with this one, we're going to go to the 70 strike. And why are we going to the 70 strike? Because we can't afford the 72 or the 75. And why can't we afford it? Because we could lose the entire amount when we buy a put. And these are over 500. So we're going to buy the 40. And when you look at it, it's interesting because this has a 38 delta, which means if this stock falls $1, then this should go up in value by about 38 cents. So here, this one it'll go up by 50 cents, but you're paying 50% more for this option, approximately. You've gone from call it 450 to, 690. So it's appreciable difference. So it's kind of relative, but we're doing what we can afford. 554, right. Okay. So somebody's asking where the 554 came from. So Susie, that when you come down here and you look at this number, if I'm hovering over today's candle, it tells us that the average this stock has moved. It's also right over here. It says 554. So that's how much this stock has moved on average from top to bottom within a day over the last 14 days. Okay. And so what does this do? Well, let's say this stock keeps going up and then it comes back for a few days and this downtrend is over. Well, then we avoided entering a losing trade. And then if we got in, we get in right when the opportunity presents itself. And so chances are we then might be able to get in and out with a profit in a shorter period of time. And again, when we look at United Airlines, does it trade more than 1 million shares a day? Check. Do we have a lot of volume on the option we're considering with the expiration we're considering? Check. Is the bid-ask spread less than 10%? Check. Okay, so we're looking to buy, and this time we're just going to buy a single, one contract, and we're going to make it a conditional entry. We only want to buy, this should be good till canceled. If I didn't do that on the last one, I'll go back and fix it. We only want to buy if it goes below, at or below 69.66. And so we know that when we get in, we want this 64.12 to be our target, but to avoid this, like, hey, what if I get in and get out at the same time because a gap down, so my entry and my exit become the same, then this saves you that angst and worry. And so, if it comes to your phone, so, when a trade fills, you can be notified a number of ways or not at all. So if you say, hey, set things up so that it sends you an email or a text, or you're just going to check twice a day before, like right when the market opens in an hour before it closes. So this is a conditional entry with an anticipated 1 ATR target. To be entered once or if, we enter the position. Okay. And Chuck is saying, might this not cost more? It might. And so, that's another reason. And so some might say, well, then maybe we should even go out further than the 70 strike. And we could consider that as well. Okay. So I really like the way you guys are thinking. I really like these questions. I think they're fantastic. Now, do you want to do another example? Shall we? Okay. So let's look at Tesla. So I was listening to some financial stuff earlier today, and this is apparently the longest losing streak for Tesla in the stock's history, the most number of down weeks in a row. And again, when we look at this, could we put this in a textbook for, flags? So, because it came down, rallied a couple of days, came down, rallied down, one day down. This was still a down day, down, rally. Looked like it came down, and today, like the whole market seems to be rallying. So could we look at this and say, hey, if this comes below this high day, we'd like to enter. Now, what do we want to do before we go through this? Yes, we could set an alarm also. So, 58 million shares traded today, so it meets that. Where's the problem here? Is it on open interest? No, we got tons of open interest. What's the problem? Not in our snack bracket. Like we'd have to come, this is 15 strikes. Oh, I don't want 125. How about 25? Yeah, we'd have to come way out here with a delta of 15. And this is, we aren't even entered yet. So we'd have to do like this 195, and it's trading at 445 to 450. But so could we do instead a long put vertical? So could we do a conditional entry on a long put vertical at, say, so if we say here, 240.73 is the low. Now, and some might just say, so our entry would be at 240.73 minus 20 cents. So if it goes below today's low, 240.53. So you could set up a short put vertical and say, well, if we want to enter when it's at around this 240 level, then might we buy the 240 and sell the 235? And we're just going to do one contract here, but we're going to make it conditional. And we know we're going to end up paying more for this to get in. We're capping our gains, but we're trying to get in right when that, still right when the opportunity presents itself. So good till canceled. And we're going to bring this over here and say we only want to enter this position if and only if it goes below 240.53. And Tesla, I mean, there has been such a backlash to their products globally from many, many countries and many individuals within those countries, because of what's happening in our political climate right now. And, I'm not here to talk politics, but sometimes what is happening politically can impact a company's stock. And it certainly appears to be doing that now. And so we're going to make this a market order. Now, what's one of the challenges with putting in a market order is that if it fills right at the beginning of the day, we can end up in, at a price that we aren't anticipating. And so we're going to put this in just, to see how it goes. Or what's our other choice? Our other choice would just be to put an alert in an alert. And so let's do that as well. So this is a long put vertical with a conditional order. So we want to buy this vertical only if Tesla goes below today's low by at least 20 cents, 240.53. Okay, and right now it's saying that would cost us $2.10. But we know that our entry price on our potential loss is going to be higher. Excuse me, higher than that. And then someone talked about alerts. So here's an easy way to put in an alert. Just right click and say create an alert. And we are going to say, hey, if Tesla goes at or below 240.53. So I just clicked an area on the chart, 240.53, let us know. And this is our entry for our long put vertical. Okay, now if you want to see alerts that you have on your chart, if you come to this sprocket, you can say, hey, show where the alerts are and apply. And then you can see we have an alert on Tesla right here. Yeah. So Isaiah is asking if we can do an iron condor. We have 2 iron condors, one on Delta and one on Micron. Delta is up 50%. Both of these have 7 days to go till expiration. And you know, Micron is up 25%. They're both. So when we look at Dollar Tree, in Dollar Tree, we kind of did a wash, rinse, repeat on. It's sitting right here. So on Monday, we'll have a look and we'll probably close out both of those. And so why not close them out now? Good question. I like the way you guys are thinking. But the reason is that we're coming into the weekend. And what happens on the weekend? Well, time decay continues to tick, tick, tick away, even though the markets are closed. And so we're kind of right in the middle here on Micron. And so, you know, as long as it stays below this 110 and above this 85 level, we should have a profitable trade. What has been working against us is the fact that volatility in the market has skyrocketed since we put these on. And so while, you know, no one would blame anyone for saying, you know, I'm up, you know, 47% on this, our target was 80, I'm going to take it. Others might say, hey, I'm going to get another, you know, $6.25 worth of theta against this, which will drop the value by Monday by 12 or 13, and that will increase my profit. And so maybe I'll just take that, you know, in the anticipation that it will continue to stay in between these strikes. You know, theta on this one, well, on Micron, it's almost 32. Yeah. So that's the thinking on that. So we'll look at that. And, you know, there are so many different things we can talk about, right? So many different things we can talk about that I kind of have to pick, you know, so with Delta, you know, if we enter this trade and we're expecting it to continue to fall, we are talking about buying a long put, and that's directional, right? Right. Nod your head. Yes. You know, because so how do we make money is if it falls and goes to our target. Okay. And our target on Delta, okay, just a second. You can put our target on the chart, actually. Our target was 41.11. So let me just change this. Here's our. So if you just draw your line, then you can come back in here and edit it, 41.11. We can say this is our 1 ATR target. And so this is only profitable given that we get in because we have a conditional entry. If it in fact goes down and we get out and it hits our target. Now, we have sometimes seen something come down to within, like maybe it gets to 41.21. So might we go in and say, hey, that's close enough. We're going to take the money and run? Absolutely. But what else could we do? Well, we could do a short call vertical. So, and the idea with a short call vertical, let me just get rid of that. So the idea with a short call vertical is that we are selling a call above this high, the high of this day, where we think it's going to stay below. And then we are buying a call above that to define our risk. Because when we sell a call, we're saying we're willing to sell you 100 shares of Delta at $47 or whatever the strike is, and we don't even own Delta. So if it were to gap up, we'd have unlimited risk. And we want to trade in a way where we are limiting our risk or defining our risk. So we could do a short call vertical. We could do a long, and that's what I call kind of sort of bearish, in that with this one, as long as it stays below, if it goes down, we're happy. If it goes sideways, we're still happy campers, right? Now, we could also do what we are attempting to do here, which is just a long put. And that's directional. It has to come down and hit our target here of 41.11. And then we can do a long put vertical. So that's our third choice. And we did kind of tee up a long put vertical. And typically what we try and do there is kind of bracket where it's trading. So, and this is directional, but not as directional, depending on where you put your strikes, as the long put might be. Okay, so here's 3 different bearish strategies. And today, really, our focus was on the long put with a short-term target. Okay. So I wanted to show you where these trading plans are going to be. So these are the candlestick patterns, and I had hoped to have half a dozen of them in here by now. I kind of snazzed this one up a bit over the first one, so I may re-record the first one, but this went up and 373 people have found it. I just posted it on Twitter just before this class started. And then if you want an idea of the 1 ATR trading plan, this is the long call with a 1 ATR target. So I like to say you'd have to kind of flip it and reverse it. But the next one I record in this series will be the long put with 1 ATR targets, and it will be nestled right in between this long call. It'll be right underneath. That's where I'll put it. And you'll see that hopefully by, end of day Tuesday, maybe Wednesday, just depending on what my schedule looks like on Monday. I'll try and get it recorded Monday. So it will be in there. But if you're looking for a template, an example trading plan that you can then use to create your own trading plan, this was something that when I started as a client, I found it extraordinarily helpful. And that's why I've created these for you. The other thing that I wanted to do is some even shorter content, now that I'm teaching getting started with technical analysis on candlestick patterns. And once I'm through the 12.5 candlestick patterns that I want to share with you, then we'll get into, pennants and triangles and, all that, inverted head and shoulders patterns and all that kind of stuff. So look for more to come in this arena. Okay. So guys, that's a wrap for today. I don't think we had a survey, but if there is a survey, Connie, would you mind reposting it? But here's what I would ask of you. If you aren't following me on X, I invite you to do that. Barb Armstrong CS and Connie Hill CS. Connie posts a lot of really fantastic content also. And then when you get over to X and you're seeing what we're posting, if you would hit the like button, it just helps more people find it. Also, if you'd hit the like button on this webcast, what it does is it moves it up in the YouTube algorithms so more people can find this content. So that would be appreciated. It also lets Connie and I know that you found this content helpful. And then last but not least, if you haven't subscribed to the channel, it's another free resource that you'll want to take advantage of. And this is on that Schwab coaching, Trader Talks from Schwab coaching So when you hit subscribe, this is what you're subscribing to. And when you first come here, it will show you what's currently being broadcast live. And then if you come to playlists, then you can scroll down and find, you know, whatever you're looking for. Or if you want a particular topic, you can just hit the search bar and type it in. Okay, so that's that. There was one other thing I wanted to share. Vincent, so he's saying, is there a webcast for intrinsic and extrinsic? Type it in and you'll be amazed what will come up. So yeah, you can find that. So guys, I applaud you for being here. Sticking your head in the sand is an approach. It's not one that I would recommend. And I think there's lots of great opportunities out there. We just have to choose to embrace them. So speaking of embracing, this weekend, get out there and hug someone you love, my friends. Thank you for joining me. Have an awesome weekend. And I will look forward to seeing you in a webcast coming up soon. Take care, everyone. Bye for now.